let's move on for the sake of time. We have 15 minutes, and we want to make sure we're staying within the time and try to at least hit all these things. So financing a deal, I'll probably take this because this typically is my area of responsibility. So obviously, if you have cash, buying a business is going to make it worth it, right? Like you either are independently wealthy or have money from savings or maybe your 401k. I don't know how people have cash, but the other way you might have cash is through the business producing a bunch of cash, right? Like your business is starting, as you start to have some success, it starts to create a bunch of cash. You have that cash sitting in the entity, you can go pay for it. Like obviously that's possible. But let's talk about like debt and then raising capital. So let's go through a few things. First of all is when we first started buying businesses, we use the cash flow, what we call cash flow from operations. So I'm not independently wealthy. Spencer is, he just does it for the love of the game. I have to work for a living, and so I'm out hustling. And so using the cash flow from the business was how we financed it. And then we would also use bank debt. When I first started getting bank debt, because there's not a lot of assets here. So just think if I quit paying the bank, what are they going to come do? Like break into our office and rip open our filing cabinet and grab a management agreement. It just doesn't sound like something that they're going to want to do. So banks struggle to finance these deals. So what our bank did is said, well, we want to go get an SBA guarantee. And I don't know the exact numbers. I think the SBA will guarantee for them like 75% of the loan. So if let's say I'm buying $1 million business and they expect me to put 25% down, that's $250,000. I may go get a loan for $750,000, and then the SBA will actually guarantee like 75% of that loan, or maybe it's 80%. I don't know exactly, and there's so some things about doing that. There are actually banks out there that can do SBA underwriting in-house. I would lean towards using one of those banks if you can. But there's also these things called SBA packagers. I think that's probably the right word. If you have a bank that's not used to dealing with the SBA, don't necessarily listen to them that they are, going to know what they're doing. These SBA packagers know what the SBA is looking for, and they collect a fee. They are worth paying the money if you need to get the SBA package to get it, because the SBA wants it like a certain way. And if you don't give it to them that way, then this process just takes forever. Now, listen, the SBA takes forever, period. So you just need to be very patient. You need to have a very patient seller. And so I would say, you probably need 60 to 90 days to close an SBA deal. And that's with 60 being like the bare minimum, 90 being more realistic. And that's with somebody that knows what they're doing. I think that during COVID, SBA got overwhelmed. So I haven't bought a business using some sort of SBA-backed financing since COVID. You can imagine that COVID, all of us were, hitting the SBA up for dollars. And you can imagine post that, they're probably still trying to dig out from the hole that was created by the pandemic. But you absolutely can use an SBA. If you have a great relationship with a bank, it is possible that they'll finance one or two of these deals. We did get the bank finally to finance one or two of them, but you're just not going to go very far because, again, there's no tangible thing for them to come get with if you ever stop paying. The second way I would talk about or think about is seller finance or owner finance. What a great way. If the seller trusts you, then it is a great way for them to make more money and for you to use essentially their equity and pay, convert that into debt and pay them out over time. We have paid some really great interest rates, especially when interest rates were non-existent. We've paid some really high double-digit interest rates to owners. And so if they trust you, then, earning a double-digit interest rates when the cost of capital, a T-bill was 1% or 0% or negative, is a pretty good deal. So if they don't need all the money, one of the great things about, especially people that are retiring from this business, they've typically owned this business 20, 25 years. They've made some really good money, probably paid off their house. They probably own some rental property that cash flows. They just don't, if you gave them all the money, they're not going to throw it all in the stock market. They just don't trust the stock market. But if they may trust you and be willing to finance you as an entrepreneur, because they kind of, one of the benefits I had is I think a lot of people saw themselves in me. And as I was just getting started, and so they wanted to be helpful and also make money while being helpful. Another way that I've financed deals, so you kind of like run out of bank. Like at some point, the bank shuts you off. If you want to read a great story about a bank shutting somebody down, Shoe Dog's a great book to read. They kicked him out of the bank. When the bank hopefully doesn't kick you out, but when they say, "Hey, Matthew, we're not lending you any more money," you're going to have to go to friends and family to borrow money and or sell equity in the business to finance some of these deals. If you can get friends and family to loan you the money, some of them prefer to do that, right? Like, hey, you may have a rich uncle or a rich, cousin that is willing to loan you $1 million, and you can pay them, some percentage rate on that, and pay them over 3 to 5 years, or maybe you just pay them interest because they don't want the money, or they want the money, but they don't want the principal paid back. And you can, over 2 to 3 years, at some point you can essentially season this thing long enough to where the bank might refinance you out. But point being, if you can get debt from friends and family, that's a great way to go. If you need to sell equity to friends and family, that's a way you can do it. The big challenge with that is like setting a valuation of the business. We've talked about valuations here, so maybe you could kind of like come up with an agreeable valuation. But if you're selling portions of your business, you got to have a valuation. We've actually utilized something called a convertible note. I'm not going to go too deep into this, but it basically doesn't set a valuation, but sets, if you ever go raise institutional capital, it was set valuation at that point. So friends and family, the thing I would caution you, there has been nothing in this business that has led to more sleepless nights than taking money from family. So I would just caution you, if you're going to do this, just know what you're getting into and make sure that you treat their money better than your money. The fourth thing there is family office. So a family office is like a rich person that may be in your market. Maybe they sold a business a few years ago, or maybe it's a rich family that's always been rich. You can go get money from them. They're always looking to invest, especially in your market, into businesses that are, they're like, when I think about Birmingham, there's like a few families in Birmingham that are really proud of Birmingham and want to invest in Birmingham businesses. And so they may invest in you. Now you're going to have to start getting to some scale and also have to show them like some meaningful valuation, future valuation, to get paid back. So they're not going to do it out of the good. Family office isn't going to do it out of the goodness of their heart. Usually your friends and family will do it out of the goodness of your heart. One thing I would also tell you about friends and family, when you take their money, you tell them that I'll only want you to give me money that you are willing to lose. That was kind of like the saving grace. Is all my friends and family, I told them, hey, and every single one of them almost made them repeat it back to me. You are, if I lose this money, I'm still going to be your dad. Or I'm still going to be your mom. I'm still going to be your brother. I'm still going to be your neighbor and friend. So just know that. And then the last thing is just more institutional capital. So we've raised from, so thus far, what's called institutional debt. So these are kind of like debt funds that have helped us buy businesses. Again, you're going to have to get north of probably 10 million in revenue and 2 million in EBITDA to do this. But there are some debt funds out there that will help you continue to grow your business as you get up there. And then, of course, we've heard about this in our industry. There's private equity and there's venture capital, which are a little bit different. Private equity is more like traditional, looking at the business from like a profitability standpoint. Venture capital is kind of what you hear the software industry that are like banking on big total addressable markets, big things happening, big billions of dollar businesses. And so there at some point, again, at about 10 million and 2 million in EBITDA, you can start to get into an area where they would be interested in financing and funding your business.